All right, every single trader hits this point eventually. Your stock is on an absolute tear, but where is it actually going next? That's what we're digging into today, how to set a target price when you're flying blind in totally uncharted territory. So let's set the scene. You made a brilliant call, your stock has just exploded upwards and smashed through its all-time high. I mean, what a feeling. But then that question hits you. Now what? Where on earth do you set your sell target when there's no history, no past resistance level to look at? You're literally sailing off the edge of the map. And listen, if this sounds tricky, you are definitely not alone. The source material we're diving into today straight up says that figuring out that next price level is one of the hardest things any trader has to do. Because, there's no magic crystal ball here. Okay, so no crystal ball, but what we do have are tools. This is where technical analysis comes in. It gives us a whole set of methods that can provide a surprisingly good estimate. It's kind of like creating a map for those uncharted waters, right? It gives us some potential islands or destinations for a stock's price. So let's check out our first map-making tool. It's called Fibonacci Extensions. This is a really powerful technique that traders use to predict where a stock might finally hit a wall, run into some resistance and maybe turn around. And it's all built on some pretty cool mathematical ratios. But what are they, really? Well, Fibonacci extensions are basically tools that project potential price levels beyond the stock's last peak. You take that recent price range and just stretch it out, forecasting where you might bump into those future resistance zones. So how do you actually use them? It's actually a pretty simple three-step process. First up, you find a major recent low and a major recent high. Easy enough. Step 2, you define that gap between them as your base range, your 0 to 100%. And then the tool does the heavy lifting, projecting targets out from there at these key extension levels. Now, theory is one thing, but let's make this real. Our source gives us a perfect example to see how this whole thing works in the wild. All right, so in this example, let's say the stock went from a low of $36 up to a high of $45. Simple math, right? That gives us a $9 difference. And that $9 becomes our foundation, our 100% range. Now, that $45 mark is the key. That's the old high, the 100% level. The second the price punches above that, boom, we are officially in that uncharted territory we mentioned. And that's our cue to pull out the Fibonacci extensions and look for those targets. And here we go, our first potential destination. A really common extension level is 161.8%. So we take that percentage of our original $9 range and we add it to the low of 36. And that gives us our first potential target price, $50. A very, very common spot where you'll see traders start to take some profits off the table. But what if the stock has some serious momentum and just plows right through that first target? Well, the next major level you're going to want to watch is the 261.8% extension. You do the exact same math, and this projects a second, more ambitious target of $59. The whole point here is that these levels give you an actual data-driven plan instead of just, throwing a dart at the wall. Okay, so Fibonacci's all about those math ratios. But our second method, it actually uses the stock's own recent behavior. Yeah, we're talking about projecting targets using chart patterns. It's another super common way traders try to figure out where a stock is headed. And the great thing about this method is just how simple it is. Seriously, it's just 3 steps. 1, you spot a pattern you recognize, something like an ascending triangle. 2, you measure the height of that pattern from top to bottom. And 3, you take that height and just add it on top of the breakout price. It's an awesome way to let the stock's own past behavior tell you how powerful its next move might be. So there you have it, 2 really powerful techniques. But before we wrap this up, we gotta have a little reality check here. As useful as these things are, and they really are, they're just tools. They're for estimating. They are not a crystal ball.
So we've looked at Fibonacci extensions and projecting from chart patterns. Both are fantastic ways to get a much more educated guess on where to set your price targets when a stock is just taking off. They really do give you a data-based edge.
But, and this is a big but, that edge comes with a huge asterisk. I really want to call out this direct quote from our source because it is without a doubt the most important takeaway of all. Nothing is guaranteed in the financial markets. These tools can fail, and they absolutely do fail sometimes. So, the final piece of advice here is this. Please use these tools as just one part of your overall strategy. They give you incredible guidance, but you can't rely on them and them alone. Markets are wild and unpredictable, and no single indicator is ever going to be 100% foolproof. And that really leaves us with one last question to think about. These tools, they give you a map, right? They show you where the price might go. But the real secret sauce, it's fitting that map into your personal travel plan. How are you going to manage your risk? Where will you actually take profits? Because that's what turns a simple map into a really successful journey.